Okay, so chapter 12, statement of cash flows. Please do read the whole chapter, but we are only doing work in the homework on the operating activities section, which is step 1, and we are only doing step 1 on the exam as well. So when you look at the statement of cash flows here, you'll see that it talks a little bit about the usefulness and the significance, and then you'll see here it talks about the preparation of the cash flow statements. We are using the indirect method, and you'll see there's a step 1, a step 2, and a step 3, and we are doing step 1 only. Okay, step 1 only. We are not going to do the free cash flow or the liquidity and solvency piece. Okay. All right, so I talked a little bit, I showed you a little bit about, how depreciation is added back because it's not an actual cash expense. Our cash actually doesn't go down from that. And the reason why companies even go through the process of creating cash flow statements is that it gives an organization the ability to see where they're generating their money from. Where are they generating their money from so they can make adjustments to what they're doing for the future. So for instance, if they found out that they were a company that was generating most of their money from, say, investing and financing, but really they were a manufacturing company and they should be generating their money from operating, then they may want to redirect their energies as far as where they're putting their assets and where they're putting their time and resources within the organization. It also helps an organization to pay dividends and obligations in the future because it helps them to know, how much cash they're really generating that they can use for that. And we talked a little bit about what the differences are for the net income and the net cash. I used depreciation as an example for that. Cash flow statements also help an organization to figure out investing and financing opportunities and what they've done through a period. Now, when I worked in an organization in a nonprofit, we actually, it was a school, and so we got paid our tuition starting in July, and our tuition ran July through April. So once we hit April, we didn't have any more money coming in. We had no more cash coming in. So what we would start doing is I would start running a cash flow statement in February, actually tracking the amount of cash that had come in to that point, and then how much actual expenses were going to occur from that point forward. And I could predict when we were going to run out of money. And what I meant about run out of money is run out of cash. So we were a nonprofit. We did, not all nonprofits do this, but we did not have a lot of cash reserves. A lot of nonprofits do have cash reserves, but we didn't have a lot of cash reserves when I first went there. That was part of the reason why I went there, was to help to turn the company around. And so in the beginning, we would have to go out to the bank for a loan. So my cash flow statement would help me to predict when we would have to go out to the bank for a loan. So we would go out for a loan probably somewhere around the end of May. And then in July, when our first tuitions came in, we would turn around and pay that loan off. So that only happened for 3 years. And then we finally got ourselves into better financial health. And so I worked there 13 years, and we still did the cash flow statement every year because it helped us to plan our cash usage within the company. So a lot of companies use cash flow statements in different ways. So again, we are only going to be looking at the operating activities section. We will not be looking at the investing or financing, but do watch a couple of the Wiley videos on that just to become familiar with those. All right, so when we look at the operating activities section, we're looking at things that have to do with the sale of goods and services, interest received and dividends received, outflows such as money paid to suppliers, money paid to employees, money paid for taxes, money paid out in interest, and other expenses within the organization. Again, we're not going to look at these two here, the investing and financing. You could look at those through the Wiley videos. Significant non-cash activities. So these are things that are non-cash activities that occur within an organization. So the issuance of common stock to purchase assets, conversion of bonds into common stock. So there's no cash that's exchanging here. direct issuance of debt to purchase assets. So you buy a car and you do it on credit, right? You open an account, so there's no cash. Or exchanges of plant assets. So you trade a truck in for another truck, okay? Companies often have a report of non-cash activities included, which talks about these kinds of things. And it's a separate note to the financial statements, but we won't be dealing with any of those. That's just more informational. Okay, we are not going to do this next problem, exercise 12.1. We're going on to the next section. This section right here is just kind of, this slide is just showing you a little bit about different organizations and you know, where they generate their cash. And you can see a difference here in how, like for instance, it shows Walmart, their net income is $11,284,000, but their net cash actually provided by operating activities is $20,169,000. So that's quite a difference. Let's see, the next slide, we're going to talk about, so the cash flow statements, you can do a direct method or indirect method. We are actually going to be doing an indirect method, and we are just going to do it for operating activities. Now, this next slide shows you a little bit of what I was showing you as far as, oh no, this one doesn't. This one is showing you what the financial statement will look like. And a cash flow statement is a financial statement. However, if you look at this on the screen here, see at the top there, it says cash flows from operating activities. And then it says list individual items. And then it says net cash provided by or used by operating activities. That's the only section we're going to do, is just those items there. The rest of it is the other reports. So that actually, that little section actually becomes quite large because you have to list the individual items underneath there. So for your record, a good example for you of what a operating section of a cash flow statement should look like, go to, or when you don't have to right now, but you can go and look at page 12-15 in your textbook. And on 12-15, you'll see a full cash flow statement. It shows everything, but just the top part down to net cash provided by operating activities is the operating activities section. So what you'll be doing is called a partial statement. And so you'll only be looking at the operating activity piece. And so I'm looking, I don't see a partial, I don't see a partial one as an example, but we will do a partial one today in the class. Okay. All right. We're not going to rebat that. This is just kind of talking a little bit about life cycles and how any organization goes through different life cycles. And so it's, you know, introduction phase, growth, maturity, and decline. And if an organization does not reinvent themselves as they start to go into the decline phase, then they will decline and go out of business. So when you look at companies that have been around for, you know, over 100 years, like Campbell's Soup, they have continually reinvented themselves in order to stay in business. Now, what this is showing you, though, is in relation to where it's from in an organization. So you'll notice that when an organization is just introduced, most of their money comes from financing. Comes from financing from the outside the organization. And little comes from operating and investing. However, as the company grows, more and more money starts coming from operating and investing, and the financing starts to decline. So that's a little bit on the product life cycle. Let's see. So when we're doing the cash flow statements, where we get these numbers, we get them from resources. We get them from comparative balance sheets. We get them from the current income statement, and we get them from additional information. Okay. So preparing the statements of cash flows. You know what? I don't think I'm going to go through these. I think what I'm going to do is I am going to move on to this slide here. So with the operating activities, we are determining the net cash provided or used by operating activities by converting net income from an accrual basis to a cash basis. So technically what you're doing is you're backing out everything that you've done the entire the entire year. So everything you've learned to do accrual-wise, you're backing out just to get these cash numbers, okay? So you're going to add back your non-cash expenses, your depreciation, amortization, or depletion. You're going to deduct for gains and adds for losses. You're going to look at the changes in the non-cash current assets and current liabilities. And that's what that list was that I gave to you. Now, this is going to go through a whole list of items, and I'm actually going to scroll down to the very end because it's going to show you one by one, and then it keeps putting a total there of net cash provided by operating, and that's not true because it only has one item on this slide. So I'm going to go down to this slide here, and here you can see all of the items that it's showing in the financial statement. So it's showing you that it starts at net income. And in the example problem, they're going through and they're adding for depreciation expense, they're adding for a loss, they're adding for a decrease in accounts receivable, they're subtracting for an increase in inventory, subtracting for an increase in prepaid, adding for an increase in accounts payable, subtracting for a decrease in taxes payable, and then cash from operating activities, okay? So I'm going to stop at that point, and then I'm going to show the Wiley video. So let me stop this recording.